Lots of things for investors to consider. We have crude currently easing, but still remaining elevated. We have the clampdown on tech in China, all not boding well for EM stocks in particular, you think?
No, I mean, this new news on further tightening of regulations in China is obviously a worry. I mean, a lot of us were hoping that might clear over the next quarter, but it's probably going to be longer than that. We have to put in mind, though, we've had an incredibly good run in the first half of the year outside of Asia. I think it's been one of the best first halves for equities globally for a long time, and Asia's lagged that. So the underperformance is already there.
The thing is, you're expecting 15% upside for EM markets. I mean, is that at risk? We're seeing more and more headwinds. Add to that the strong dollar.
Yeah, the strong dollar is not so much of a worry this time, and particularly because the RMB's been quite strong. And it will hurt those current account deficit countries like Indonesia, etc., and obviously Turkey, and also the oil price as well. But as long as 10-year bonds stay where they are, then that's probably not going to be a problem. The problem really is that the indexes are very skewed to China, and China's really underperformed since the beginning, sort of mid-February. But the rest of EM's actually performing quite well. If you look at the performances from markets like South Africa, like Brazil, like Mexico, markets we haven't seen perform for quite a long time. So it's more about being selective.
Sean, I mean, with tapering, on the agenda, and indeed a rate hike some ways away, this is all negative, though, for risk assets such as emerging markets, given what it may mean for a pullback as people see perhaps some advantages in terms of spreads and the like.
Yeah, the two things obviously worrying the market, or the big debate at the moment is about, transitory, is inflation transitory, and what's that going to do if it's not to 10 years? And then obviously the talk of tapering, and we will probably get, as they say, people talking about tapering in Jackson Hole. But, we've had a very, very good run in Europe, in the US, and we've underperformed in Asia. So we think markets pause over the summer. We think there's no marginal good news. We've had a very strong economic recovery, good vaccination programs outside of Asia, and that's been reflected in strong equity returns. Fixed income, we're still not seeing that great a return there. There is a risk that treasuries rise. We've got a 2% forecast in 1 year's time. So yeah, it's taking a bit of risk off the table, but there's no really alternative to equities. So, we would be buying into any weakness, into the fall. And EM's been an underperformer within that. So I think EM has different conditions that it had in the past, and particularly with the dominance of China, Korean semiconductors, Taiwanese tech. Those are areas that actually have all lagged their US counterparts and should pick up in the second half of the year.
Sure, tell me, OPEC and this deadlock with the UAE at the moment, the standalone opponent to what the Saudis want to do and what everybody else wants to do. This has led to many people suggesting that oil's price, perhaps at least line of resistance, is to the upside. Now, that's particularly bad for emerging markets if we get high oil prices for longer.
On average, it is bad for emerging markets. There are obviously some markets like Brazil, like Mexico, and Russia that will benefit from that. Yeah, we think in the short term, Rish, that we will get more pressure on the upside of oil. We've already had a 50% return this year in oil. But medium term, we would prefer copper because it's sold off. Obviously, China has been sort of trying to stop speculators in it and releasing strategic reserves. But we think that copper is the long-term winner in the commodity space. And then in a sort of 6 to 8 month view, you'll start to see oil come off. But short term, the risk is up.